Like trillions of people who came before me, I'm trying to answer a question that will plague mankind for as long as equity markets continue to exist. Does Benjamin Graham's net current asset strategy or net strategy still work? To answer this question, I'm doing a backtest of the 22-year period between April 1st, 1998 to March 31st, 2020. To run the backtest, I'm using QuantConnect. I'm focusing exclusively on US equities. QuantConnect gets its data from Morningstar, and the Morningstar dataset includes approximately 5,000 companies. The dataset excludes illiquid OTC stocks. I'm following the strategy in its simplest form. I calculate net current assets by starting with current assets and subtracting both total liabilities and preferred share. Then I divide net current assets by outstanding common shares and compare that with the share price. If the share price is less than 66% of the net current assets per share, then the company will be selected for the portfolio. I'm aware there are many variations of the net current assets formula. Some people like to include operating leases as a liability. Some people like to take a haircut on the accounts receivable or other asset classes. I know these variations exist, but I'm just going to keep things simple. Each year on April 1st, the eligible universe will be pulled and filtered until the only remaining companies are the ones that meet our criteria. Then an equally weighted portfolio will be put together on the earliest trading day and held until March 31st of the next year. Each year's portfolio starts with $100,000. The commission scheme used is the fixed rate pricing for Interactive Brokers Pro. I have to admit, I struggled over how to handle commission. On one hand, many brokers no longer charge commissions. On the other hand, payment for order flow really does seem to extract some sort of value from the investor. The compromise that I reach is I'm including commissions for buying, but not for selling. So it's like only half of the commissions are included. If that seems weird to you, don't worry. I'll discuss the impact of commissions later. The data is not perfect. I picked a small sample of companies and verified their financials with their 10Ks and their 10Qs. And while overall I was pleasantly surprised by just how accurate the financial data is, I did find some anomalies. First, there seems to be a problem with how Morningstar records total liabilities. When the company's balance sheet has a line for total liabilities, it seems to work just fine. However, when the company's balance sheet doesn't have a line for total liabilities, the database seems to record some random number. As a result, some of the companies selected might not actually fit the criteria. Second, I also saw a case of one company that did a reverse stock split, but the database didn't update the share count and the price accordingly. So if you were holding that company on the day of the split, you would have instantly had a 1,200% gain. This case didn't fall within the backtesting period, but there could be other split errors that snuck themselves into the backtest. I used the S&P 500 as measured by the SPY ETF as my benchmark. Now you could correctly argue that because most of these net stocks are microcap, I should have been using a microcap ETF. However, just because it's more popular, I decided to use the S&P 500. The results in my backtest are in this table, which I will go over right now. Starting from the left is the period column with all 22 years of the backtest and the total backtesting period at the bottom. The rest of the table is divided into columns detailing the backtest for both net and SPY investment strategies. The first column in the net section are the number of companies in the portfolio for that period. The second column is the portfolio value. Each period begins with $100,000 in portfolio value, and what you see in this portfolio value column is the value of the portfolio at the end of that particular period. The next column, return, is a percentage increase or decrease in the portfolio value over that period. The drawdown column shows the largest percentage downward movement in portfolio value within the period. And finally, the cumulative value and cumulative return columns show the portfolio value and the return realized if you had continuously applied the strategy over all previous periods. Down at the bottom in bold are the maximum drawdown, the average drawdown, and CAGR over the entire backtesting period. The SPY section of the table is set up identically to the net section, except it is missing a number of securities column. The SPY strategy only utilizes one security, which is the SPY ETF, and that represents the 500 companies of the S&P 500. The net strategy had a higher CAGR over the 22-year period of 6.36% versus SPY's 5.71%. If you started with $100,000 on April 1st, 1998, on March 31st, 2020, you would have $388,000 with the net strategy and $339,000 with SPY. That's almost $50,000 more for the net strategy over SPY. Once again, I'm only assuming commissions on buying and not selling. If you were to include the commissions for both buying and selling, then the net CAGR would go down to around 6%. If you were to assume no commissions at all, the CAGR would be around 6.6%. The outperformance generated by the net strategy seems to be driven by the high return early on in the year April 1999 to March 2000. If you had started net investing in April 2000 rather than April 1998, there would actually be no net outperformance at all. In fact, if you started net investing any time after April 2000, your returns would either be similar to SPY or significantly worse. For example, if you had started investing in April 2006, in March 2020, after 14 years of investing, you would be down 17.39% overall. Whereas with SPY investing, there are no comparable stretches of time that would have resulted in a negative return. The net strategy is much more volatile than SPY. The average drawdown over the 22-year period was almost twice as high as SPY at 29% versus 16%. The net strategy also had negative returns in 11 out of 22 years, whereas SPY only had negative returns in 5 out of 22 years. There are also years such as April 1998 to March 1999 and April 2014 to March 2015 that had significantly negative returns, but the SPY was actually up. On the other hand, there were no years in which the net strategy was up, but the SPY was down. One of the criticisms of trying to use the net strategy in today's market is you won't be able to find enough stocks to keep a diversified portfolio. Imagine my surprise when I saw that the smallest portfolio in my backtesting period held 102 companies and the largest portfolio held 509 companies. I have 3 theories as to why I was able to find so many net companies. Number 1, as mentioned in the known error section, there are a number of companies that probably only made it onto the list because their total liabilities were understated in the database. 2, I didn't set a minimum market cap, so I suspect many of the companies are microcap or even smaller than microcap. Many people probably wouldn't even consider investing in companies of this size. 3, when I was sampling the portfolios, I noticed there are many small biotech companies that had no revenue history whatsoever. These entities were basically piles of cash with an R&D department working on new drugs. Again, many people probably don't include these in their portfolios even though they meet the net criteria. While my backtest does show that Benjamin Graham's net current asset value strategy did outperform SPY in the 22-year backtesting period, the outperformance was entirely driven by 1 year of high returns early on in the backtest. Without the return from April 1999 to March 2000, the net strategy would have performed the same or far worse than SPY while also being significantly more volatile. To answer the original question, no, I don't think Benjamin Graham's net current asset value strategy still works. Thank you so much for watching my video. A write-up of this video is linked in the description below, along with the code that I used to do my backtest. If you know anything about QuantConnect, I would appreciate your feedback and review of my code. Please leave any comments or questions below. If you want to contact me directly, you can use the contact form on my site. Subscribe to my channel, like my video, and share it with everyone you know or don't know.